Since the 1970s, employees have had the opportunity to contribute to and invest in 401k plans, which allow them to invest in stocks and bonds to grow their money ahead of retirement. Americans have $8.7 trillion invested in 401ks alone. The executive order opens up that money to more opportunities, such as private equities like State Farm, cryptocurrencies like Bitcoin, and other infrastructure and real estate investments.
What that means is it just gives the average person the same opportunities that only very, very wealthy people used to have.
Phil Cooper with 210 Financial says the average person never had these options because there are more fees, more risk, and less transparency involved. Private equities don't have the Department of Labor looking over their shoulder. They don't trade 24 hours a day and have no obligation to pay you back after a loss, which is why this change could be controversial for plan providers and employers under the Employee Retirement Income Security Act.
They're allowing certain investments in there without doing the due diligence on those investments, and those investments turn out to be too risky, then the person who put those investments in that plan could be at risk for wearing some of that.
While there's a higher risk involved, the reward could also be high. Cooper says older folks closer to retirement should consider the liquidity of alternative assets, but young investors have room to play around.
They're willing to take that risk because it's not tomorrow grocery money. This is money for 30 years down the road. So by offering the democratization of this, it's really, really going to open up an opportunity for people to take on more potential risk, but potentially have a greater reward with it too.
Cooper says the average investor likely won't see alternative assets open up for investment opportunities for at least 6 months, while the Department of Labor provides guidance to 401k companies. Then each provider will determine how fast they want to open up that market. Lizzie?